here we are looking at this saying, okay, it's been driven by the macro, it's been driven by the central banks, liquidity, inflation, and our job is to look forward the next 2 years, 3 years, 5 years, and say, is this current state of affairs going to be permanent or temporary? Well, the history of economies is the business cycle goes up and down. It's cyclical. So therefore, with the cheap levels, we're kind of at key trend lines, and almost every time we get here, the crypto market 10 or 20 X's from here. Now, that's not a guarantee that it does it next time. So your risk reward is highly favorable, and you've got the shifting macro where we're going from maximum pain in the economy to starting to see the central banks change their course and start adding liquidity back because they've broken the economy. So therefore, you really should be focused when everybody's scared and everybody's puking their crypto, their ETH and Bitcoin. You should be thinking, now's the time to accumulate it. And I learned this the hard way. The big lesson, even for me who's been in financial markets for 30 odd years, is when you've got an asset that trends so strongly and is so volatile, these sell-offs are your friend. Unless something fundamentally changes with the story. And we don't see that. It's not been banned by every government. People haven't walked away from it. It's the same with the personal computer, the same with Amazon. Amazon, when it went public, fell 96%. And then it went up and then fell at 80% and then down and then up and down. And it had the same adoption curve as people adopted the Amazon network. And really, the only person who ever managed to hold on to it was Jeff Bezos. My view is that we're still paying for the effects of COVID that cause all sorts of problems, like nobody could manufacture anything, nobody could ship anything, planes couldn't go anywhere. And so as COVID started to ease, people came back out of their houses, back into the office, back to consuming things, and there were no goods to be bought because all the shelves were empty because nothing got manufactured. So that caused this huge rise in inflation. Then the next thing, the central banks think, oh my God, it's inflation, because inflation's pretty bad because most people's wages haven't gone up as much as prices have, so everyone feels poorer. So the central banks think, God, we need to do something about this. So that's the Federal Reserve and the Bank of England and all these guys, and they raise interest rates, and that usually slows down the economy, and it has. The economy is actually falling off a cliff because they probably over-tightened. So even though we kind of know things are bad, the forward-looking stuff that I look at using my kind of macro framework suggests things are going to get really quite ugly over the next 6 to 9 months. So what the Federal Reserve are doing when they raise interest rates is they're taking what's known as liquidity out of the system. So what they're saying to banks and others is, we're going to allow you to have less money to use around the system. So that means it's harder for anybody to borrow money. It's got more expensive, your mortgage has gone up, your rent's gone up, so everybody stops spending and the economy slows down, and that brings down inflation because there's less demand for goods. But it has other effects as well. Obviously, people start becoming unemployed again, which, people were kind of saved a bit by COVID, by the stimulus checks and what happened. But this time around, there's nobody really wants to save them because the Federal Reserve has said, we actually want unemployment to rise. So they want you to lose your job. So you buy less goods, so the price of goods falls, which is kind of a bit screwy, but that's what they want. And that whole mechanism of the Federal Reserve doing this has unwound a whole bunch of asset prices. So the stock market fell. I think the Nasdaq's down 30% as we're speaking, and the S&P's down 25%. The bond market collapsed. It's one of the biggest falls in the history of the bond market. Housing prices are coming down very fast. The price of oil to the price of commodities has collapsed. The price of cryptocurrencies has collapsed. So it's been a really, really tough 9 months in financial markets and for people's savings and investments, and potentially for their jobs too. Crypto is a function of two things: technological adoption and macro, the liquidity that the central banks are providing. Those two things are the key drivers. So if you zoom out of a log chart of crypto that everybody always tells you to do, you can basically see things like Bitcoin go just up over time. And up a lot, but it's very volatile. You get these kind of big ups and downs. So the question is what drives the big up, and then what drives the ups and downs? The big up is driven by the adoption of technology. There's now 300 million people using cryptocurrencies or investing in cryptocurrencies. It's growing at about 100% a year or so. It's the fastest adoption of any technology the world has ever seen. So people are adopting this twice the speed of the internet. That's why it's been so profitable, but it's also very volatile. And it's very volatile because when the central banks remove liquidity, which they've done in 2013, 2015, and various other points, cryptocurrency collapses because there's less money around for people. And this particular example, what's just happened over the last year, is to do with the fact that most investors in crypto are actually retail investors, and they dollar cost average. So they put in some of their paycheck every month. Now the issue is if your paycheck's gone down, in purchasing power terms, you have less money to invest. So suddenly, cryptocurrencies are less active, the networks are less active, and the price has gone down. So does that change the long-term picture of the adoption of blockchain technology? Well, when you look at it and you see everybody from Nike to Gucci to Ticketmaster, you name it, all using blockchain technology, it's not going away. We're just in this period where it looks pretty ugly and feels pretty ugly. If you think of the big financial market participants that we've been waiting for to enter the market, some of them have. So these are the big pension funds and hedge funds and others. They're also struggling from lack of liquidity because their portfolios are going down from what the Federal Reserve are doing, so they have less money to put into crypto. So I spend a lot of time speaking to these big institutions, and they're all ready to get involved, but they just don't have the cash right now, much like we don't have the cash because everybody's feeling the pinch. So if everybody's feeling the pinch, it's not going to drive up the price. But once this situation eases, it'll start driving up the price. Now there's another piece of magic that happens with crypto, is crypto doesn't do well in inflation because of the reasons I said. But when the central banks start printing more dollars or euros or pounds or yen or whatever it is, that's called debasement of the currency, quantitative easing. And that is when crypto does really well. So one of the reasons I've been very closely following the prices in crypto recently is because as we start getting a worse and worse economy, we know eventually rate rises will give way to rate cuts. Quantitative tightening will go to quantitative easing, and those conditions are literally perfect for cryptocurrencies. And you can see the markets are trying to test this out now. They've been basing for a while, since June mainly, as they start to watch the economy start slowing down dramatically and expecting the Federal Reserve to change course. The better is a subjective thing. You know, it depends what you want to use it for. So Bitcoin not being the fastest, cheapest is not a problem because it's more decentralized, so people want that element. So different people want different elements. All I look at is break it down. What drives price? Price is driven by Metcalfe's law. So why I got very bullish on Ethereum is I could see that people were building a lot on Ethereum, and the Ethereum user base was growing fast as a rate of change. It was earlier in its adoption, and therefore the price goes more exponential earlier on. Because when you go from one person to 50, that's a 50x increase. When you go from 50 to 100, it's a doubling, right? So that's what drives the value of these things. So I was very, very bullish Ethereum, and I still am. It's still the majority of my investments. But Solana, I noticed that a fast blockchain is going to capture different use cases where we really need speed and cheapness. And Solana also has been focused on the kind of mass adoption stuff. So they got NFTs, and they did quite well from NFTs, but I see conversations that they have and what they're working on. You know, these are the guys who built a phone. So they're thinking of consumer adoption. Well, other chains like Avalanche might be looking at financial system adoption. So I think consumer adoption, because there's a lot of consumers out there, and I think that if the trend of adoption for crypto continues as it is, we'll have 1 billion users by 2024, and we'll have 3 billion users by the end of the decade, 3 or 4 billion users. So that means that chains like Solana should do well if they're focusing on that part of the market. I see it's earlier in its cycle because Solana only came out 2 odd years ago. And so therefore, if I'm right, and it's an if, then we should see it outperform because it's earlier in adoption. So it's going from the 1 to 50 and not the 50 to 100. And it should see a huge growth in its network. Now, I may be wrong. It may be another chain that catches the world's attention. But Solana feels like a decent bet, but I wouldn't bet my house on it.